Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to be using. Well, the markets have been going up or down based a lot on the word tariffs. So how should you handle this? Also, the word stagflation is now being used occasionally. We'll discuss what that is and whether you should be concerned. It's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. Thanks for joining us once again for The Bull, the Bear, and You. Now, the last time we met, the S&P 500 was dropping toward correction territory, and it did not take long for the index to hit that 10% decline. And as is common, after hitting that correction target, the S&P 500 has staged a rally, rising more than 2.5%, maybe 3% now from that low. But as a journalist, and boy, I love that word but, I have to say there are many who believe that it's going to be a tough sledding for the economy coming up. And if the economy is in for turmoil, what will that do to your portfolio? Well, sometimes the best laid plans are not as viable as I believe they would be. I'm going to launch into something which may have been thrown asunder because of the Trump administration is now adjusting its statements about tariffs. So, having said that, in 24 hours it could change again. So I will continue with my original plan. It's a tough decision as to exactly where to begin with this approach I'm taking today. No one expected the Fed to act on interest rates when it met last week. But the chairman had to say, what the chairman had to say did buttress the concerns many have over proposed tariffs. That, in the end, will cause inflation and stall growth. That leads to something called, in the economy, stagflation. Carrie, you were the first one to bring up that word a couple of months ago. You raised it even before the election. So why is stagflation such a concern?
Well, when you have economic growth slowing and inflation going up, it doesn't really make for the characteristics of an economy that can grow. It really stifles to a large magnitude consumer spending, and our economy is still made up 70% consumer spending. So it's all of us and how we spend money. So if prices continue to go up, but yet people are losing their jobs and we're not getting raises, you just can't spend as much. And that is very slowing. It kind of perpetuates into further slow growth. And you really have to look at, we usually get into a period of stagflation because of external issues. So, you go back to the 70s and the energy crisis. And that was something that was external to the normal workings of an economy. Usually, if you have inflation, the Fed will do what it takes to curb inflation, like raise interest rates. And if you have growth that is slowing, you'll see the Fed reduce interest rates. So in a period of stagflation, what does the Fed do? Because if it lowers interest rates, it perpetuates inflation. If they raise interest rates, it stifles growth. And that's really where we get into the issue as to why some of these political policies, how and why they can affect an economy. So I'm sure that we'll talk a little bit more about, what's happening and how you said that this could change in 3 hours. I get that. But what's not going to change in 3 hours is that the uncertainty that this has created, the concerns that people have, the more kind of, is it going to happen, isn't going to happen, is it or isn't it going to happen, it doesn't really set the course to clear the uncertainty which the markets don't like.
That all being said, the Fed is slowing down their runoff of their balance sheet. They're still letting it expire, so they're leaving money in the system, which will help the growth side a little bit. It also creates demand for bonds, which should elevate prices and causing interest rates to go down in the bond market. What we have to remember is that the economy and the stock market are not the same thing. And the stock market is driven by emotion on a day-to-day basis, but over time it's driven by earnings. And I think that we'll see earnings, in a couple of weeks we'll start seeing earnings again.
Yes. So I have, of course, a kind of a weird view on this whole thing. I don't think economists really, even though they're very stern about warnings, I don't believe they really have a great hold on where inflation comes from. The whole stagflation was at this really weird time where the name was invented and where we really felt it was, as Carrie points out, in the 70s, and a lot was happening at the time. We had a couple of oil embargoes that made oil go incredibly high. We had a huge amount of people entering the workforce. And then finally, we had the Fed that was going off of the gold standard in 71, although, much of what they were practicing with respect to monetary policy had been going on for a very long time, but it was still that final thing that killed the gold standard in 1971. So we had a lot going on. Something that I think causes inflation is M2. So that is the amount of money that's being added to the system. The prior administration correctly had to make sure that people had food, clothing, and shelter during the economy shutdown, which we never did before in 2020 and 2021, and it took a while to get it, the economy back. But a lot of people think more money was created during that time than necessary because it went on into 21 and 22. And if you look at M2 and map it up with inflation, there is a relationship there. I cannot literally wait until tomorrow at 1 o'clock, which is when the monthly monetary report comes out, and we can see whether or not, the theory that M2 is driving inflation. What's happening with M2? We're going to get another bit of data. Finally, things are not as, even though the consumer is down, it seems as if they're still spending, because I just looked at today's Chicago Fed National Activity Report. And this is a metric that's supposed to look 6 months into the future and kind of gauge what's going to happen to the economy. They really haven't had a great track record of using this, because I don't think it's been around that long, to predict recessions, but theoretically they should be able to see it. And oddly enough, in February, the economy got stronger. Wait, what? We all, all the consumers are upset and theoretically pulling back, and yet, according to the measures that the Chicago Fed looks at, the economy is looking stronger. So this is really hard to forecast. Really hard. All this data.
Michael, your thoughts?
Yeah, well, Kim threw out a lot of economic terms there. So, and while she won't be able to sleep tonight because of her anticipation for the monetary tomorrow, I'll be sleeping just fine. I think when it comes to stagflation, we are, as Kim definitely mentioned, we're nowhere near what we were like in the 70s. The world is so much more different, from everything Kim pointed out to the fact that we are such a more, even though we're moving towards a protectionist economy, we're still a very, very globally interconnected economy. And I think stagflation is probably the biggest risk to the equity markets near term. But I also think it's going to depend on, so what came first, the chicken or the egg? Is it the stag or is it deflation? Because I think the best way to cure inflation is through a mild recession. I don't think we're going to hit a big recession. So you get economic growth that slows down quite a bit. That should, in theory, bring down inflation as well. and one will eventually kind of beget the other in that regard there. The markets are already sort of paring back the anticipated number of Fed rate cuts through from the numbers this morning. It's down to about maybe 2 from 3 on Friday. So I do think that, again, as Carrie pointed out, the biggest risk to the markets near term is going to be the stagflation. But as I've been telling clients, put your head in the sand for the next 3 to 4 months, because nobody knows what's going to be happening in the economy of the markets, given all the geopolitical rhetoric we're seeing here. The markets are going to be very volatile, I think, over the next 3 to 4 months until businesses get clarity one way or the other, whether it's 25% tariffs or 10% tariffs. Once you have some sort of clarity, businesses will be able to operate a little bit more. We'll have a little bit more, a better runway to forecast what we think is going to happen from an earnings standpoint. But until that point, I think it's going to be a bit of a bumpy ride.
Well, you just answered the question I was going to ask you, and that is, what should investors be doing right now? So I'll ask the rest of you. Do you agree with Michael that you sit back and kind of wait to see how things play out?
Well,
Yes.
Go ahead,
Oh,
Carrie.
go ahead, Frank.
I think that our job is primarily to take the events that are happening and figure out how to turn them into profit. So I think that with what's happening, there will be some changes happening in various companies because they will be positioning themselves to take advantage of whatever it is. For instance, in Europe, the developed countries in Europe are beginning to expand their defense budgets. So there will be more money spent on that, and those stocks, of course, have already reflected that to a large degree. That's our job. So to just sit there, I think, is probably a mistake. But to run is just as big a mistake. I think that what needs to happen is you need to sit and say, well, this is changing, and who is that going to hurt, and who is that going to help? And if you own who it's going to hurt, sell it. And if you can figure out who it's going to help, take that money and put it over there.
I think the big point I was trying to make, Frank, is not to do nothing, but to try to make investment-related decisions based on what you think may or may not happen from a geopolitical standpoint, based on whether it's Donald Trump saying, I'm going to do this or this. That is a futile experience. I think from an investment standpoint, things are changing, to your point. I mean, we've been, at Fragasso, we've been underweight the international equities for 6 years now, since 2018. And most of my time over the past few weeks is determining whether it does make sense to slowly move back into a more neutral weighting to the international markets. And that is stemmed from some geopolitical events that looks like it's going to have a long runway, right? What Donald Trump has done to the European bloc and saying you need to spend more money on your defense to protect, other NATO allies. That is looking like it's, Germany's not going to be as fiscally austere as they had been over the past 1-2 decades or so. So that spending over there, to your point, Frank, might likely translate into more opportunities for those international stocks. So yeah, don't do nothing, but at the same time, I wouldn't make blanketed investment decisions based on whether it's going to be 25% tariffs, 10% tariffs, what's going to be this and that. So that's kind of the things we're looking at as well.
Yeah, I completely agree with what Frank and Michael said, particularly about international, and I'll touch on that in a minute. I will say that our approach to this really comes more from the perspective of how do we manage the risk. And in doing that, that leads to where the opportunities are. One of the things that we did for our clients going into this year, particularly for those clients who are relying on their portfolios to generate income, is that we strategically looked at the portfolio and said, okay, where can we put that cash flow that they need aside so it's not at risk? So we don't really care how much volatility we have with the portfolio as long as we know that we've secured their income for a period of time. The other thing is that as it relates to international, we were out of international for a long time. And last year, kind of seeing where valuations were, so driven first by, you look at price earnings ratios and how expensive a market is, the international markets were very cheap. Now, I've also been a believer that you just don't buy because something's cheap. you need to have a catalyst. But we started to get back into international last year. And to Michael's point, what's happening there, we're asking ourselves the same question. Is this sustainable? Is this activity that's happening with Germany and the European countries really needing to have to kind of reinvest in themselves? And we do. So we're pulling our percentages back to where they optimally make sense. This is why I think having a financial advisor makes sense, because the investors that are out there trying to do it on their own, they're not going to really pay attention to international until maybe June, right? They like get a quarterly statement and they're like, wow, international's up 20%. Right now, international's up like 11 versus our market that's down. So, you know, do we think it's too late? It depends on the client, right? It depends on the risk tolerance. But this is this kind of data, what Frank, what Michael, what they were talking about, this is where we add our value. So,
Well,
yeah.
I have to ask this question then. As analysts and advisors, are you doing a lot of this from the gut as such? I mean, how much research do you have to put in to say, well, this is happening here, so this might happen over here? And when I use the word might, are you making kind of a bet that this is the way it's going to go?
The answer to that question is there's quantitative information and there's qualitative. So we subscribe to various research services that give us data on various countries in the Eurozone. So we can see what the trends are. So if we look at what are called PMIs, Purchasers Managers Index, and we look at those trends, particularly in the Eurozone, over the course of the last few months, they've been increasing. So that's a sign to us that, hey, what's going on there? So that's the quantitative, the data. And then you look at the qualitative, which, you know, is it gut or is it reality? And the reality, to Michael's point, is, you know, Europe has to do something. And these countries are behind, you know, their politicians in making these decisions. So, you know, it can't just be data driven. I think the qualitative is really what leads us to say, is this a sustainable trend? But there's got to be facts. Like I said, just because the market's cheap doesn't mean we're going to buy it. There's usually a very good reason why markets are cheap.
So some of the reasons why, oh, and just to clarify, I pay attention to the macro, but I don't make equity decisions based on what I think the macro is going to do. I am looking at individual companies. So I'm different than the rest of the participants on the show a little bit. But here's my thought on Europe and actually South America. So occasionally people look at the demographics of like South America and say, that is a wonderful growing country. Why don't we invest in there? And one of the classes I took in my MBA program to become what I am today was contract law. And apparently South America, and in particular Brazil, has really onerous, terrible contract law. And, you know, businesses are just not protected. So anytime, you know, the traction starts going in Brazil and people start getting excited, I'm like, wait for it, there it is. You know, some kind of company gets punished by this lack of business law that we have in the US. When I'm looking at Europe, I see a sea of regulation and a culture that has not rewarded innovation for hundreds of years, maybe. And tech, I'm talking to you. SAP is probably the largest tech company that has come out of Europe and done really well. And what is it? It's a fancy pants accounting package, essentially. It's a good accounting package, but it is not exactly AI, right? It's not bending the frontiers. It's doing accounting really good. So these are the kind of things that dampen my appreciation of a cheap stock in Europe because of the track record of culture, lots of regulation, and equally bad demographics that the U.S. has. Kind of, we're heading in Europe's direction with respect to demographics. But that's all I have to say about that.
Okay, well, that kind of segues into the next thing I wanted to bring up, and that is that today the S&P 500 is up more than 75, getting closer to 100 points at the moment we are talking. It could change again, so that's on the positive side. And the decline in the market so far has been relatively small. Only the Nasdaq was down more than 5% for the year. But, and there's that word again, but the headlines are looking negative. These are all from the Wall Street Journal in the last 2 weeks. On March the 11th, consumers keep bailing out the economy. Now they might be maxed out. On March the 13th, consumer angst is striking all income levels. March the 14th, consumer sentiment tanks as Americans expect more pain ahead. And it's go on to say the uncertainty around the economy, stocks, and jobs take the toll. One economist called it horrific. On March the 15th, consumers and businesses send distress signals as economic fear sets in. And then on the 17th, retail sales edge up in February, but they miss their expectations. So, Frank, you have always been a lover of the headlines and what the journalists all have to say. I know that. So do you turn a blind eye to these sort of things?
Well, I mean, I'm going to point out a few of the words you read. Might, maybe, signs, all right? None of these things are definitive. They're all speculation. It reminds me, I get these feeds because I guess I look at sports where these journalists run out and tell the world what the Steelers ought to be doing, who they ought to be going to get, and it's all speculation. And these headlines are a lot like that. They're not definitive things. They may happen, some may happen, none may happen. I doubt all will happen. There's no question that we're seeing the economy slow down. You can walk into many restaurants now without making a reservation. So that has changed. Not all of them, but many of them, or some of them. And that being said, there's no doubt that there's a slowdown going on. Now, how severe is it? It remains to be seen. And the journalists are spend a lot of time getting everybody prepared for what might happen. And often it doesn't.
I mean, Frank just stated, the reality of the world we live in. Like, the media is selling newspapers and headlines. But it doesn't change the fact that it's always like this. We never know. And that's why having an investment process is essential, because there's never, I've been doing this almost 40 years, okay? There has never been a time where I've woken up and said, today is the day to invest. Never. Almost every day you wake up and say, well, what's going to happen that's bad? So, there is a level of, this is like therapy now, right? There's a level of acceptance that comes if you're going to be an investor, and that is the unknown. So, we're trying to create consistency from markets that are highly inconsistent. And that's really why diversification matters. And that's really why professional advice is helpful, and there are people that have their own investment process, but most people just don't have the time. And, I say often, what we do is we save our clients time. We work with very smart people that if they had the time and the interest, they could probably do this, but they don't want to. They have other things that they want to pursue, or they can make more money.
It's a really good point that Carrie brings out. And I think we all know that Stacy made his bones in this industry by being a fearmonger. So it's always been the case here. But, in the economy, in the stock market, there are things that are working now and there are things that aren't working now. And so it's our job to try to find, and say, Frank pointed out, the things that are working now. And that as we speak today, it's the international markets. It's also part of the fixed income markets that are finally starting to pay a decent amount of income that Kerry talked about before in terms of getting that to your clients. The big thing is it's protecting your assets when you have that eventual rollover. The easiest thing to do for an investor is to sell and get out, because, oh my gosh, I have a ton of relief. I'm not going to weather this downturn anymore. But there is never, ever, as Kerry pointed out, there's never a bell that rings to signal to get back in the market. To her point, I've been doing this for a while as well. I've never ever said, as Kerry said too, it's not now. It's a great time to buy into the markets. The best time usually to buy is when everything is going to, hell in a handbasket, and that's really, a great time to get into the markets. But as an individual investor or even a professional, it's incredibly, incredibly hard to do so. So really being diversified, trying to mitigate those downturns, and in diversifying your assets in certain areas that might be doing well, might not be doing well, is the best way to sort of, ride out any sort of storm that might be, occurring in the markets.
Okay.
Years ago, Stacy, I saw a cartoon in, I want to say it was Forbes magazine, and it showed Paul Revere riding through Wall Street screaming, "The market is going to fall, the market is going to fall." Or maybe he was saying, "The market's going to go up." That doesn't happen.
Okay.
So I started in this industry as a sell-side analyst, and that means you are the marketing department of stocks for the brokers that call people and say, my analyst likes Microsoft, hates Oracle, let's do this trade. But where I'm going with this is my director of research was arguing hard with compliance to, on the top of the banner, like the written word was what my product was. And you had to assess risk in this stock. And on Wall Street, believe it or not, volatility equates to risk. Like if a stock trades faster than the market is going up or down, or does it more, a percentage higher than the market, it goes up more when the market goes up, it goes down more when the market goes down. Compliance wants to slap the high risk category on that stock. And I remember this fight that the director of research was having with compliance, saying, the price tomorrow is not the risk. That is not risk. And I think we have to remember that we're looking at an individual, your ETF or mutual fund is a collection of individual stocks that each has the risk of going out of business. And if your people pick well, that really is the risk, right? The bond not paying off, the company, going to zero, not whether or not the price goes up or down. And I think that's something, if you're a do-it-yourselfer, to kind of back away from. Price is a signal, but it shouldn't be the driver of your trading, whether to get in or out. There's other factors that you should look at.
All right. Well, good. Now we also know that you're non-compliant.
Well, yeah, maybe. No, actually, we're very compliant. I understood what the argument was about.
Yeah, exactly. Well, I'm going to stay with you, Kim, because you always look at earnings, and so I have to ask the question, as we're getting close to the next earnings period, how were they? And you also said that you were shopping. Did you buy anything? You don't have to name what it is, but did you buy?
Right. Well, I'm not, because my compliance person doesn't like that. And I am the compliance person. No, I mean, there's rules. I can't tell you what I did or did. I did a little bit of buying, but not tremendous. I think I'm going to start buying a little bit more here in the future. I've got some ideas with a capital I that I don't really want to discuss or can't discuss right now. But I think overall, first quarter is a weird quarter because, fourth quarter, which is what we just reported in the first quarter, is a weird quarter because a lot of companies are ending their fiscal year and they flog the salespeople to get their, yearly bonuses. So they can bring forward a lot of sales, which makes now the next report, which is the current quarter that we're in, Q1, a little tougher for salespeople. And companies correctly and historically have guided a little soft. I saw some guidance coming down from what was anticipated by many analysts in companies, and that's good. But overall, I would say that, companies are not cowering unless, they're expecting a pretty good year this year. Not tremendous, but they're not slashing their earnings expectations for the next quarter or for the year all that incredibly much. They are being appropriately cautious, I would say. And I like that because nobody wants to miss an earnings forecast. So I think they're appropriately set at this point.
Well, one thing that we may see when the earnings start coming out in a few weeks, we may see things be not quite as good as we thought because we had a particularly cold winter. And that probably put a little damper on retail sales at least.
Could possibly be true, yeah.
Which
All
really
right.
has nothing to do with the economy. It has to do with the weather.
Yeah.
An equally impossible thing to predict.
They try it anyway. Yep. All right. Well, we'll continue our look at investing in the economy in future editions. And since you are watching or listening to this particular program, I ask that you hit the subscribe or the like button on whatever platform you happen to be using. So for right now, thanks for joining us, and we'll see you again in a couple of weeks.